Hey everybody, it's Pete. Welcome to Stocks for Breakfast. And today we're going to talk about something everybody loves, which is how to handle massive profits that happen really quickly. I think it's probably one of the biggest challenges that people have is when you expect something to happen and the stock market delivers in a way that you can't possibly have imagined. And it kind of really throws you for a loop because you're not sure how to manage these gigantic windfall profits. And I'm actually going to show you a couple of charts actually before we kind of get into the game plan for the week. We're kind of talking about these kinds of move last week, where Broadcom, actually a very simple trend line break, led to a $200 rally. Caterpillar just launched out of this pause here for another $25, so a little bit less than a $10 move, 10% move there. So we're going to actually talk about how to adjust when something happens in a way faster than you could possibly have imagined. And myself and John Napolitano, our options guy in our community, have a very distinct way of looking at the way price action unfolded over the last 7 weeks and what that means for position sizing right now. So as we get into this week's game plan and go over the market sector rotation, what the Fed did last week, massive spike in volume last Friday, which was due to options expiration. We're going to talk about why I am lowering my position size on new swing trades that are unfolding right now, how I plan to manage winning swing trades right now, maybe give you some insights on how you can manage some of your wins right now, and why price action and volume is implying smart money is selling on the way up right now, probably taking some profits off the table, probably going to be dipping their toes in a little bit less as we head into the last 2 weeks of the year, which is crazy how fast did 2023 go, and how the stock market has just delivered a Santa Claus rally for the ages, where we haven't paused at all for 7 weeks. So this is going to be really exciting to review. So just stick around just 1 second. I'll be right back. Okay, so obviously everything we discuss here is for educational purposes. It's up for you to make that final decision. It's my mission to help you make better decisions. If we do a good job today, please do me a favor, hit that like button and make sure you subscribe. I get a really good feedback from you if what we're doing is working for you and helping you make better decisions. The one thing I want to talk about today is actually a book that I bought way back in 2000, maybe even prior to 2000. I'll take a look and see when it came out. And it's really the theme of today's topic, which is reading price action and volume, reading what the market normally does, kind of putting those clues together, and then that will affect what kind of risk you are willing to take, what kind of risk makes sense. And there's a couple of different kinds of risk. There's a market going into a downtrend, going sideways and reversing. So the first time it's reversing is one type of risk because we're looking for positive feedback. Another type of risk is when we have an established, what we call stacked order flow, where there's clean pushes and pauses and everything looks kind of beautiful. We could probably see that over here in Sherwin-Williams. You can see push and a pause, a push and a pause, a push and a pause. And as you start to get more feedback from these pushes and pauses, your conviction level goes up, your likelihood of reaching that next profit target or justifying the risk kind of makes sense, right? Even if you haven't traded this stock in the last 6 or 7 weeks, just at RCL, and be aware CCL actually has earnings scheduled for this week. So what I want to kind of work your way through is that as you start to get up to these loftier levels where stocks kind of push to levels that they haven't been at in a while, which obviously a lot of stocks hit all-time highs last week, including Apple. Can we talk about Apple right now? Apple actually grinding higher, printing new all-time highs last week and kind of pausing right at that level. So some indecision. Now, the big thing we're going to be looking at this week is this, the bottom part here, which is volume. Now, we're going to actually walk you through this in the daily ticker because I want to give you some insights that we kind of had when I had my trading floor in New York City. Specialists from the New York Stock Exchange were trading there. I had NASDAQ market makers trading there. So we kind of brought a nice little mix of my particular style of trading, what it was like to be a NASDAQ market maker working that order flow, the New York Stock Exchange specialist working that order flow. You start to notice things that are a little bit deeper distinctions that you might not see if you're just doing kind of regular basic technical analysis. But the book that I want to point out, this is actually the book here. You can probably see it. The Trading Game by Ryan Jones. So I just want to actually put that up there so you can see it. Okay. Now, again, I'm just recommending this because it's a book that's actually mattered to me. This came out in 1999, so I actually remember the date when I bought it. The book actually really makes a good argument for understanding how to adjust your position size up based on market conditions. And that's really a big part of it. It goes through a whole bunch of different trade management and money management strategies, for lack of a better way of putting it, fixed ratio trading, martingale system, a whole bunch of them, right? But here's the thing I want to talk about. When we choose to accept risk, we have to recognize what is the likely profit potential and what are the odds of that continuing. Now, as long as the trend is still in place, no matter how you look at the trend, whether you're using stochastics, MACD, Bollinger Bands, moving averages, just drawing trend lines, it doesn't make a difference. Obviously, the way that we do it is we're tracking and stacking order flow. You need to know, is it still valid? And you need to know what would possibly happen for you to say that the story is changing. And if the story remains valid, what do you do with your trade? Obviously, if it's still valid, you hang on and you keep moving up that trailing stop loss. But what happens if the story changes? What does that mean for not only how you manage that winning trade, and we're going to talk about those parabolic moves that we just saw there before, Caterpillar and Broadcom and a couple of other ones. But what do you do with the trade that's kind of grinding higher, but volume starts to tell a different story? And we're going to kind of point that out here in the S&P 500. And we're going to actually dive into this a little bit deeper when we start to look at the daily ticker, right? So you can actually see here, volume has increased dramatically here, and the average volume, never mind the last 2 days. Last week, we had the Fed announcement, we had follow-up from the Fed announcement, and then we had options expiration, which always catapults volume. But we can't ignore it because options expiration is usually higher volume. They're kind of getting pinned at that price level. But we have 2 days of pausing in the S&P 500 on massively heavier volume. So this is really the point that I want to get across. And if you really want to level up your ability to read price action in the stock market, you have to start paying attention to volume. Volume, the money people are actually spending are their commitments. Now, there's certain types of volume, and really the only two that you really need to know is it continuation type volume, or does it look like the story is changing in volume? So in other words, a potential reversal. Now, this is where a lot of people get it wrong, okay, and kind of mix things up. All we're looking for is, has the story changed? But in order to understand, has the story changed, and have an answer to that, you need to know what the story is. So the story is a push and a pause on light volume. A heavy volume push, so move to the upside on heavy volume is good. A pause on light volume is good. A light volume pause implies continuation. So if we can go back to a couple of the stocks that we just looked at, and let's actually take a look at RCL, you can actually see here pretty cleanly during this pause, volume dropped below the average, right? We pushed up again, and then during the pause, the volume dropped below the average of the volume. And now as we're going higher, this is still good, right? That's good. We're seeing an increase in volume on the move to the upside. But now during this sideways movement, we're starting to see a little bit heavier volume. So what we're essentially saying here in a lot of the stocks that we're watching right now, you don't want to say they're too high because they could always just keep going. But what we are seeing is the story changing, and there's a way to define that. When the story changes, it doesn't mean you just bail out of the position. But what it does mean is that you need to recognize that something different is going on, from a push and a light volume pause to a push and a heavy volume pause. So you want to write that down. Again, hopefully you have Post-it pads on your desk. You have them all over your monitors and you're taking some really good notes. That's the story change that you need to know. Now, here's where most people make the mistake. They're just like, oh, it changed. I got to get out of it. Don't do that. Again, everything we hear is for educational purposes. When you see a change in the tape, that's part of tape reading, it means that you need to now be aware you might need to be on top of your game a little bit more with managing profitable trades with a trailing stop loss. Now, we get questions all the time about what is the proper trailing stop loss. Well, it really depends on what kind of profits you're going after. Are you just going for the next move? And then as soon as that thing slows down, you're hitting the road? Or when that thing pushes and pauses, instead of looking to get out because it slowed down, you're looking to add to that position. That's what you need to decide, because which type of profits you prefer, cash flow versus a little bit bigger holding period of time, that will dictate what kind of profit taking strategy you will use. So if we kind of work our way over into RCL again, as we see it pushing higher, generally speaking, what some people will end up doing is they will have a price based on what it's doing that they will allow it to pull back to, and they're out. They're done. Somebody holding a little bit longer and playing for a bigger move, they will probably use stochastics or MACD crossover or a moving average crossover or something along those lines to tell them, okay, I'm going to give it a little bit more room to breathe. I'm okay with losing some unrealized profits in exchange for a much bigger move. Now, that's one way of handling a trend that's moving perfectly in your favor. Push up and light volume pause. But what if you get a push up and a heavy volume pause? In that particular situation, what we used to teach people to do and what we do now in our community is when something changes, our strategy needs to adapt to different conditions. So in this case, where we're seeing a lot of what looks like smart money selling on the way up because we're seeing heavy volume pauses, right now for me personally, I'm not calling a top, but I am getting more aggressive with moving up my trailing stop loss, where previously I might have been willing to give a little bit more room in exchange for a bigger move. Because of how far it's moved over the last 7 weeks, and because we are seeing a heavy volume pause over the last week or so, I'm going to be a little bit more aggressive with moving up my trailing stop loss. Now, I'll just give you one example of what that might mean. So let's say you probably know William O'Neill and Investors Business Daily. They're very well known for having a stop loss number of 8%. So they're looking to risk 8% in exchange for making 20% or more. So they're looking to shoot for that initial close to 3-to-1 risk reward. But when the situation changes, you then change what you're willing to let the stock pull back on. That's under a normal market condition. So when you spot these kinds of things, I want you to write this down, a heavy volume pause, you would maybe, and again, just give you ideas to think about, instead of risking 8% on a pullback, because the situation changed, you probably move it up maybe to 5% or 4%, so that if that story unfolds the way it looks, you're kind of reading the tape and saying this is a good chance that the follow through is lower and a pullback is more likely, and you're going to lock in those beautiful gains for the year. Now, again, if you're investing and you're holding on to something for years, this doesn't really apply. There's a whole different set of strategies for this. But I think most of the people that are a part of our YouTube community, most of them are either day trading or swing trading. Probably a good 80% of them are swing trading. Maybe you have a job, maybe you have a full-time, maybe you have a company, actually. So these are the kinds of things to think about. So if we kind of go back to looking at RCL, instead of allowing it to maybe pull back to where the last breakout was, you might be more inclined to be moving that up a little bit higher just because of what's going on in the market right now. Very important. So if we kind of work our way into why we're kind of seeing this, we work our way over here to what we have as our metrics. And this is really where a big part of that comes in, is normally, as we say, roughly 4 to 6 stocks meet this criteria of double normal volume. Now, because of options expiration day, 102 stocks met the criteria. So between the Fed, between the last 7 weeks, between options expiration, the market is starting to look like it's kind of changing hands or changing the tune. So how do we kind of work our way over into crafting a game plan for this current week? Now, I just want to come out here and say this before I get all the way down to the bottom of this, because I want to make it clear. Myself and our options guru, John Napolitano, kind of came to the same conclusion without even talking about it. Every Saturday we hold a swing trade session, And it's a really nice back and forth, usually an hour to 90 minutes, looking at the previous week, mapping out the current week that's coming up, looking at the pockets of opportunity for during the week and say, where can we get a little more aggressive? Where do we need to be aware that news is coming out, that kind of thing. But we both came to the same conclusion that with the volume changing, with the end getting heavier, with the end of year coming up, and on top of what is likely exhaustion or cleanup prints of that bigger move. And I'll explain what I mean that in a second. Here's the whole point. We are still taking swing trades. I want to be clear about that. We're still taking swing trades. Moving up trailing stop loss is a little bit tighter, but here's the thing, and this is why it kind of ties back into this book. This is all about position sizing. I am taking the same trades, but I am reducing my exposure to the market because of what I'm seeing as I am reading the tape. Now, that might be new to some of you, where you might think that every single trade is the same amount of risk, but just think about this. Some deals are simply better. Some deals simply have better risk reward. Some deals are okay. Like, you might be like, okay, I like that idea. Maybe the stock is pretty okay, but the market might not be perfect. Maybe sector rotation is not necessarily perfect. And in this case, perfect means it's kind of off the charts. And we're kind of rotating into different sectors right now, which I'm going to show you that as well in a second. So that's the point that I want to get across here. I want to actually tie it into something funny. Somebody that texted me on Saturday night asking me about the markets, kind of tying into the whole thought process. If you traded way back in the day during the dot-com boom, it was very, very common where you kind of like read the cover of the newspaper. At that time, I lived in New York, and the cover of the New York Post or the Daily News would have like a cab driver on his Palm Pilot, showing you stock quotes because he was trading while he was driving. And that was, generally speaking, when it all ended. Like April of 2000, it started to kind of peter out, and that was the end of it, right? So I'm not saying that this indicator of what I'm about to show you is the top, but it is making me think about trade management different. So to recap that, just so it's super clear, I want to make sure you get it. I am moving my trailing stop losses higher because of the change on the tape, change in the volume that I'm seeing, and new swing trades. I am lowering my initial position size for that same reason. I'm still taking trades, but I am lowering the amount I'm willing to put into new deals right now, new trades right now, because of that circumstance. So the biggest thing you want to write down, and you want to put this on a Post-it pad, every trade is unique. Every profit and loss that is likely for that trade is also unique. So if every trade is unique, that means that you need to learn how to adjust your exposure, the capital you're putting into the idea, up or down based on your ability to read the price action. Okay, so let's now get into what we're talking about in the daily ticker. I want to share this with you today. So here's kind of the fun part of it. My cousin texted me on Saturday night. He's not a trader, but he asked me if it was time to buy stocks. So again, love my cousin, but I think we're all here at 7:30 in the morning. We can actually look at this and be like, okay, if somebody does not really know that much about the stock market asked me if this was a great time to buy, what would you be saying to them right now? What would you tell them? Would you say, yeah, this is a fantastic time? Or do you kind of have your spider sense tingling and say, you know what, it might be a little bit late and wait for a little bit of a better spot to get in? So we're going to kind of follow up on that thought process, okay? And this is kind of like going back to the Palm Pilot days. When everyone gets giddy about the rally, that's usually the time to book profits, okay? So just keep that in mind, how I gave you the context of all this. It does not mean I'm getting out. I'm going to give it a chance to keep going, but I'm moving up my stop a little bit tighter. It does not mean I'm stopping. It means that I am looking for new trades with lower initial capital size. As the stock market completed the 7th consecutive week of gains, one has to ask if the engine was running out of gas. So now what I'm kind of implying there is the engine kind of revved really hard last week, especially, and it kind of like, boom, they used the last of the gas that they had with all of those circumstances. Now, I know the market's up a little bit this morning, but again, this is why we're not getting out. We're giving it a chance to what we have, which is called a bullish echo. And actually, you know what? I want to come back on the screen because that's kind of fun to explain as well. When you have a stock that has what's known as capitulation, where you have this massive move, let's say for weeks, which we've had in the market right now, and then over a couple of days, you get these two giant green candlesticks on massively heavy volume, right? Or you get a pause on heavy volume. But the key here is it's after that 7 weeks of buying. That's known as capitulation. Capitulation generally means that that's the end of that buying or selling pressure. In this case, buying pressure, because the end of that 5 million, 10 million, 20 million shares of what's going into that stock, the end of that order happens, and it happens generally in two big spikes like that. Okay. But here's the thing. It's not a signal to just get out. This is where we have something known as the bullish echo. So you want to write this down as well, because you need to start to create kind of like a library of price action. So you can say, where is that in the book? There it is. That's what that means. So a bullish echo means that it's super obvious, but too far from an optimal entry. And that's kind of what we're seeing in a lot of the ideas. Again, we can go back to Caterpillar right now. It's super obvious, but not necessarily even close to what we might call an optimal entry. The optimal entry was down here during this pause, which was almost $25 ago. So bullish echo is allowing it to continue just a little bit more, but being a little bit more aggressive with moving up a trailing stop loss. Okay, so just in case you just missed that whole lesson, what I just gave you, what's important here is let's say Gardner. Let's use Gardner as an example. Let's say Gardner owns a hedge fund, and he has a order from a client, or maybe it's his own hedge fund, and he's in charge of building a position in a particular stock. So let's say Caterpillar or RCL or whatever the stocks are that we just showed you. He's not just going to go out to the market and say, let's buy 20 million today. He's going to accumulate that over days and weeks, maybe even months, depending on the liquidity of the stock, right? So as he starts to get near the end of that order that he has to fill, maybe he's got 1 million left. Maybe he's got 2 million left. And then he'll call up Andrew, and say, look, Andrew, I have 3 million shares left of this thing. I need to get rid of it. Can I sell it to you over the next couple of days? We're probably going to push it up ourselves because I'm the only one who's got really big buying pressure here. And once I stop, it's probably going to reverse. You start to see these big green spiky candles with massive volume. Completely legal. It's nothing more than two people saying, yeah, I'll take those shares off your hand. Okay, great. What price do you want? And that's where that big spike comes from. So it's essentially the end of that particular idea. That's the big thing you want to talk about. So I want you to take this lesson. Increased volume generally reverses the current trend, either fast or slow, but you need to pay attention to it. Fast if it's after a long-term move. So like we have right now, 7 weeks of a move to the upside, so you can get that big spike. Or if it goes sideways, churns on heavy volume, takes a little bit longer, usually 10 to 20 days. That is generally speaking the smart money selling into that move as well, because it's not moving, but volume is very heavy. So these are kind of things you want to add to either your playbook or whatever the heck you want to call it. I know Mike over at S&B Capital calls it a playbook, which is a great definition. Either way, start making notes of what you're looking for, and then you'll know if it's there or not. Again, if you're struggling in the market and it's a little bit overwhelming, it's very important to understand that when you know what you're looking for, you're never lost, which also says that when you know what you're looking for, you're eliminating most of everything else, which also makes it much, much easier. So what are you looking for? Heavy volume push and a light volume pause. That's it. Don't make it more complicated than that. The more of those you see, the more maturity that order flow has, which is where we're getting into order flow stacking. When you see that stay that way, you're good. Continue to manage your profits in a way that makes sense. But when you see that change, a heavy volume push and a heavy volume pause, you sit up in your seat, you say, I saw that last time it happened, and now I got to manage my profits a little bit more aggressively, where maybe you let it fluctuate 8% normally, maybe this time you say 4% because something is changing. But you're not just bailing because you want to give it a chance to have a bullish echo, which is maybe one more day in that direction. Okay, so kind of mapping everything out before it even happens. All right, so let's continue with the daily ticker today. All right, for the last 6 months, we've spent many hours discussing capital allocation. So again, getting back to position sizing. At the start of a reversal, we trade lower initial position size, looking for positive feedback so that we can begin building a new position. So if we kind of go back to, let's say this, right? We have pushing down, and this is the first sign. If this is the first sign of a reversal where we fail to make a low, we would have a little bit less initial position size. But as we push and pause on light volume, we have a little bit more feedback and we can get a little bit more aggressive in our conviction that we're going to get follow through. So the first sign of a reversal, a little bit lower position size. As we get a little bit more into the move, we have a little bit more conviction because price action is doing what we're looking for. Now remember, I just want to really highlight this because this matters. When you know what you're looking for, that's not predicting. Predicting is, what do you think is going to happen a month from now? Where do you think this is going to be a month from now? Nobody knows that. I'm just telling you straight up right now, nobody knows where it's going to be a month from now. But we can tell what's going on now, and now you have a roadmap to say it's still valid or something is changing. You can control that, which is the most exciting part of the trade now for you, because now you're not looking to say, I'm afraid because I think it might reverse. Now you are saying, I'm in this position and I know what it needs to look like if it does reverse. Dramatically different way to look at trading, and reduces your stress by like 90% because you're not afraid anymore. You're literally saying, if I see this or if I see this, I know exactly what to do. So let's continue into the story of how this week is unfolding and what that means for position size. Okay. The reward potential is obvious if a new trend emerges. So we just saw that, right, in a couple of stocks that rolled to the upside. As the new trend gains maturity, more pushes and more light volume pauses, momentum in both legs, we get comfortable increasing allocation, so a little bit more into the deal because we now have proof the institutions are continuing to buy more shares. How do we know that? They're paying higher prices, heavier volume, and then they take a break. And then they pay heavier prices, and then they take a break. All right? Higher highs and higher lows prove someone with deep pockets likes the value at these levels and believe the future is where they're going to keep pushing it, right? As we gain more confidence in the current situation, we believe the risk reward makes perfect sense and our conviction increases through each new dollar of profits, right? That's perfect. We know that prices are never too high to continue. Again, we just talked about that. And that picking a top is a loser's game, but something nags at you. Something doesn't feel right. And that's kind of what we're seeing right now. This is the moment you separate yourself from the crowd. This is the difference maker. You don't need to continue stepping on the gas. You don't need to continue trading bigger. Heck, you don't even need to trade if it doesn't make sense. I'm not saying to bail out of good positions. That would be crazy because you're still sitting on these good ones. Some of the trades we have 20% or more in the last 10 days or even less. We're not talking about direction. We're talking about risk reward. So if we kind of work our way over into what we just talked about there in Caterpillar as an example, when Caterpillar or any stock has a parabolic move like this is a little bit different from a push and a pause. This is a push and wow, we're into orbit. So now this is a different scenario. When you have a different scenario like this and you have windfall profits kind of just unfold in your lap quickly, that means now you need to make a different decision. Now the decision is, what kind of profits am I willing to risk? And I want you to write that down because it's a very unique thing that I teach. When you have windfall profits like this or bigger profits, what kind of profits are you now willing to risk? Are you willing to risk the massive profit you just got in a couple of days? Or are you willing to risk that next big move and book the current profits? These are the decisions that you need to make when you get these fast, amazing, big green candles that happen in just a couple of days. 20% in a couple of days in some of these stocks is just literally amazing. In some stocks, it would take 6 months for that to happen. It happened in 2 days. As the market adjusts, you have to adjust with it, and it requires different decisions. It would be foolish to be risking all the way back to your entry price just to hold on to this trade and give away a windfall profit like that. Professional traders would be more inclined to be taking some off the table and what they call trading around a core position. Okay, so let's continue with the daily ticker. Now, what are the odds of a new swing trade bringing a reward potential worthy of that overnight risk? That's the question you should be asking yourself right now. 7 straight weeks of buying is impressive. So without calling a top, we need to know what would make us set a new trailing stop loss. What would we need to see to sit up in our chair and say, volume. Volume is the fuel that drives the engine, but where that volume happens is an important distinction. Now, here's the important part here. Traders on the floor of the exchange would call this a cleanup print. So I just taught you that. It's the final part of that order that they've been working over the last days, weeks, and months. Some call it capitulation. It's the end of that buying or selling pressure. In my community, I call it exhaustion because I want you to think about the buying or selling pressure has exhausted itself. It doesn't give us an exact top or bottom, but it does signal a change in the tape. Now, this is the biggest thing that I want to get across here to you, okay? If you understand what price action is supposed to look like to expect it to follow through, not predict, but to say, I expect this to continue because nothing has changed, that gives you one set of profit-taking scenarios. The second set of profit-taking scenarios is if what you expect to have happen changes. And that's what we're looking at heading into this week. Heading into this week, we're looking at a different set of circumstances based on that massive volume that we saw before the Fed and finalizing with options expiration last week. Okay, very, very important. Caterpillar chart is not a bull flag. A bull flag is a push and a pause over 4 to 6 days. Caterpillar right now is a one-day consolidation. And to me personally, maybe that's how you look at it, Cristobal. For me, it's only one day. If we can actually go into, let's say we take a look at, let's say that right there right now, it hasn't really paused since this move. If we go to RCL, this is a flag. You pushed and you paused for 3 days. You pushed and you paused for 3 days. You pushed, you paused for 3 days. You pushed, you paused for 2 weeks. You pushed and you went sideways for 4 or 5 days. One day is not a bull flag. One day is just one day. As a matter of fact, it actually still made new highs. So for me, that's not a new one. Okay. So anyway, thank you for that. Thank you for that, Cristobal. Appreciate that. So essentially what we're talking about right now, and I just walked everything through, that's how we're looking at the market in the current market conditions. All right. So how does that translate into what we're looking at for trades right now? How does that translate into new ideas? So obviously, I'm going to give you a copy of this. Don't worry about reading the entire thing. You can actually get a copy as soon as this video is produced. What we want to do now is we want to start to pay attention to some sectors and some stocks that have either rallied recently or stocks that are now pausing after a rally. And actually, you can see here some of these regional banks. That's a pause. That's a pause. That is the stop to move up your trailing stop loss. Same thing here with SPG on the real estate side. This one actually led the move to the upside, and then we'd have to go into some other ideas which paused over here, but have not paused over here. So essentially what I want to get across here is this week is going to be a challenging week to find risk reward that makes sense. If you have existing profits, fantastic. Continue to ride them up in any one of the trailing stop loss manners that I just described. But be aware the tape has changed, which then means you need to now go and find some ideas that are closer to an optimal entry, which Caterpillar is not right now. SPG is not right now. Broadcom is not right now. And start to move over to ideas that if you accept risk, the next reward is worth carrying that overnight risk. That's the challenge for this week. With so many stocks exploding, and heavier volume, it's implying we are going to see a bullish echo and not a bullish momentum move. So that means you got to dig a little bit deeper into the well of sector rotation, industry groups, and stock scans to find ideas that still make sense, that are worth carrying overnight. Now, here's the thing that I want to leave you with today, because this is really important. Nobody is saying you have to trade every single day. Jesse Livermore says it in Reminiscences of a Stock Operator, and every trader will tell you. There are certain periods of time where you look for new opportunities and you have a lot of conviction in them. Right now, the smarter play is to be managing those winning trades, which, by the way, congratulations. Awesome. It was there and you took advantage of it. And any new position with the heavier volume pause that we're seeing after a 7-week rally, should really have a second thought of what is the right amount of capital to put into that idea. It's really important. All right. So hopefully I gave you a little bit of a different way to think for this week. What I'm going to do now, though, is I'm going to give you access to my game plan for today, as well as the options trading game plan for it as well. So I'm going to post the link to that in the description below the video. You can grab that, make a copy for yourself. You can read it, whatever you want to do with it. Grab it below the video in the description. If you have any questions about anything we talked about today, also, please leave a comment below. I'd love to hear from you. I'd love to get back to you. One more thing. If we did a good job of helping you learn something new today and give you some actionable insights, do me a favor, give us a thumbs up and hit that subscribe button. It would mean a lot to me. All right. Have an awesome week, everybody. Grab that link in the description below, and I will speak to you soon. Thank you so much.